Good day, everybody, and welcome to Lesson 12 of the Ben and Boz Narrated PowerPoint series. I'm Boz.
I'm Ben.
Man, this is the last one. Well, how does that make you feel?
It's a little bit sad. We've had some good times.
We have had some good times, yep. You gonna shed some tears tonight?
I think you shed plenty of tears
You
last
think
night,
I
sir.
shed tears? That is a lie, everybody.
I don't know about that. We'll leave it as a mystery.
Yeah, we'll see about that. All right, everybody. Well, we're gonna pull it all together today with the lesson on financial statement analysis. And what financial statement analysis really gets into, well, I guess we'll just start with an example and talk about what it gets into. So you got a company here, Ben, and if you were just to look at their income statement, what would you say are some positive trends within that company?
It's like pretty healthy net sales growth here. Just
Definitely.
growing that a little bit.
Definitely. That's the big one.
I mean, that's the biggest one. I'm
yep.
trying to look at those expenses, and none of them are going down, but I'd expect that they would increase just as revenue increases. A lot of those will be variable, going up as well. So
Sure. Well, and then what are some negative trends when you look at this company?
Well, like we said, the expenses are going up, right? But it's tough to know just as a percentage from looking at it this way. Is that more normal or is it faster in sales? So I jumped down to the bottom there, and it's the income from operations that looks like it peaked in 2013 after healthy growth from 2012. But in 2014, we're down to 178. So it looks like something odd or something happened in 2014 I'd want to look at. Why did that go down?
So we got a growing company, but who knows if it can sustain profits, right? Which is obviously a big concern. This is in millions, so this is an $88 billion company there.
Not small.
Not small. So its share price, December 31st, 2014, was about $3.10. So just kind of looking at those financials, I don't know. What do you think the share price is going to be today?
You know, I think it's probably higher. Just thinking with that revenue growth, maybe they had that low year of income from operations where maybe they're really pushing the revenue growth, expenses got away a little bit, but you know, once they establish that, control the expenses a little, and I would say it's, I don't know, higher. 2014, that was
3 years ago.
Yeah,
so
3-4 years
yeah,
ago.
It's been a good
Maybe
stock
like,
market run, maybe 15% return per year average the last 3 years
I'm
or
just
so.
gonna throw like $500 out there.
You know, the $500 share price. Well, let's find out. Actually, let's quick look at more years. So again, that was 2012, 13, 14. Now I've got for you here an income statement for 2015, 16, 17, and again, these numbers are in millions, so the company's revenue has grown to $177 billion. What do you think now? What do you think about the share price?
Very nice sales growth. Maybe a little bit higher than $500, but I feel like you're trapping me.
You trapped me. Well, you actually helped me create the PowerPoint, so you know what it is. The share price.
I do. I'm trying not to give it away though.
The share price is $2,000, and this is Amazon.
Did anybody remember from what lesson was that where we used Amazon? Was that lesson 2?
We were talking about the income statement, I know. So I would guess lesson 3. So,
lesson 3.
We talked about different types of revenues they had.
Yeah, I think you're right.
So raise your hand if you remember that it was Amazon. All right, Ben's raising his hand.
No, I'm not.
We didn't have to tell them. They wouldn't have known of the difference. All right, the overview of what we're going to cover today. We're going to understand the purpose of financial statement analysis.
That sounds beneficial.
Yeah, we're going to learn how to perform percentage analysis, and we're going to learn how to compute a variety of ratios as well. Just like
you love ratios, don't you?
You know, if there's one topic that I probably like just about as much as anyone, or any topic, or that I think I can do really well at, it's financial ratios.
As any other person.
Well, no, I misspoke there. This is just about my favorite accounting finance topic, financial ratios. I'm excited for them. So
I'm excited for you. It's like Christmas for Warren.
That's why I'm leading this one. I would not have you couldn't have paid me to lead this one. But all right. So the purpose of this is there's 3 main groups that are going to use it, and in financial accounting, we're mainly concerned with lenders and investors. So lenders want to determine, should they make a loan to the company, and if so, at what interest rate. Investors, they want to decide whether to purchase stock in a company, or maybe they already hold the company and the company issues new financial statements and they can check out what the new ratios are saying. And then also, this isn't the purpose of this course per se, but managers also look at financial ratios in order to figure out which areas to improve.
Yeah, a lot of compensation metrics are based on ratios, financial ratios, and usually the board just sets, here's what we want to focus on, and it's up to managers to improve them.
Yeah, it's a good point.
Cool.
Now, the first type is percentage analysis, and we're just going to spend a short time on this, but if I pop this one up here for you, Ben, Goodyear Tire, Is this easy for you to analyze, just kind of looking at this 3-year income statement?
Yeah, I mean, some of the bigger items, right? Like net sales are flat from last year, basically small increase and down from 15. And looking at income before income taxes, again, just usually top and bottom is what I jump at when I'm going to analyze these. So.
But if we look at this, income before income taxes is actually down in 17 compared to 16. And if we look at it, we may or may not be able to quickly tell why that happened. It's not because
what the main
sales,
drivers
right?
were. Yep.
Sales are up, so it wasn't because of that. So what we need to do is put everything as a percentage of sales. Now it's as a percentage of sales. So what's jumping out to you, man? Why did net income fall?
First thing, it looks like cost of goods sold was up from 72% of revenue. It went up to 76%. So something got away from them a little bit, maybe.
So if you do this, I like math in my head, so I could initially look at that first income statement and see, cost of goods sold grew by more than net sales. That's a bad thing, right? But people who don't like to do math in their heads, or sometimes it just gets more complex, right?
Yeah, you could just look at the raw dollar amounts right there, not even as a percentage in your head, fairly easily on the big ones. But percentages, I think, it just makes it easier for me to put it all common size as a percentage of net sales. So.
It just pops. So we can use that, and we can say, okay, this company is having problems controlling cost of goods sold. They are doing better with selling general and administrative expense, as an example, but really cost of goods sold is a huge concern right now.
Do you ever do this on the balance sheet, Boz?
I would as well. So in that situation, I would make everything 100% of assets, as an example, is what I would do. I think investors are probably looking the most at income statement results. That's why we just showed this one here. But absolutely could do it at the balance sheet to see how much are receivables or inventory or property as a percentage of total assets.
Just nice to see everything relative to that one base metric.
You want me to stop the presentation and create a balance sheet for you too and start over?
No, I just want everyone to know that you could do a balance sheet and do it all off of total assets. So.
Gotcha. All right.
Mission accomplished.
Sounds good. How do you expect Goodyear's stock has performed? So if you just kind of look at that, Ben, the financial statements, what would you expect? How they've done, from 2016 to 2017?
Well, I would say a healthy jump from 15 to 16, but either flat or decrease 16 to 17 would be my guess.
Yeah, because net income was down, right? So they actually did go up a little bit from the beginning of 2015 to the end of 2017. And again, they had a jump in the first year, and then it went down in the second year. So they went up about 18%, including dividends they paid. But the overall stock market, the S&P 500, was up by about twice that.
So that is a good point anytime you're analyzing a stock, which is somewhat off topic for this, but also kind of fits into our third learning objective here, is that you want to compare it to some sort of baseline. So just on the surface, if you hadn't brought up S&P 500, I'd say, okay, 18% return over 3 years. 6% a year, that's okay, right? That's not too bad. But then when you see the S&P 500 is up 36%, then that's significantly underperforming the rest of the
benchmark.
market.
You don't want to lag the benchmark, right? So, all right. Well, if we hop into ratio analysis here, we're going to spend.
You should see the smile on Boss's face right now.
I am excited. Yeah, that's right. But why do we do this? We make more meaningful comparisons of the company compared to itself over time, and the company compared to, a competitor or an industry group. So let's see an income statement for a sample company off to the right. So what do you think, Ben? How is that company performing? Can you tell much just by looking at that?
Outside of seeing they have a positive operating income, that's about it. I don't really know what to compare it to, or what's the baseline, just like you said in the last slide.
Yeah, if I told you that's in millions, meaning that it's $25 billion company, they're making $1.3 billion operating income.
So somebody's doing something, right?
It's fine, right? But we don't know where they've been before.
Did you take Trinket Honey, LLC? That looks familiar to our income statement.
Yeah, but we have to round it differently. That's $25 of revenue, so $1 of operating income.
Okay.
Yep.
So we're positive.
Exactly. So we looked at this. We couldn't tell much. Obviously, big company is about all we could tell that's at least making some profits. But let's put a second year side by side here. Now, what do you think about this company's performance?
Not so good. Probably going to get punished in the market a little bit, which is kind of odd to think about. A company could make $1.3 billion, but it's all about being compared to the baseline or prior years. And as you see, they're down significantly in operating income and sales as well.
Yeah.
So
sales and income are down, so we could look. The overall stock market was up 17% this year. How do you think this company performed, Ben?
I bet they would be down 5%.
Down 5%. They were actually down 26%.
All right. I didn't even look on the slides for that one.
That's true.
Was just a guess.
You kept that one fun. This was Macy's, down 26%. I don't know how they, do well anyway. The only time I shop there is when they have like huge deals.
Weddings.
So that's
a lot of people
Gift
register
registry.
at Macy's for weddings. So.
We did back in the day too. That's right.
Did you?
Yeah.
Was it Macy's back then? Or?
I don't know what it was called. It's gone through about 8 name changes. So,
yeah.
but I don't even know what I gave you when I came.
40 years ago? 50 years ago?
20. I'm only 45. So I don't even know what we gave you for your wedding. Oh, we took you out for dinner.
You took us out for. It was a great wedding gift.
Yeah.
Thank you. We were registered
nice
at Macy's
some wine,
though.
Yep, some karaoke. But
a good night's ending karaoke. Back on task.
That's right. All right, so ratios. So there's kind of 5 groupings of ratios. As you can see, growth, profitability, asset utilization, pricing, and liquidity/solvency ratios. Within growth, we're going to look at how a company is increasing its revenues and net income. Within profitability, we'll look at profit margin, gross profit margin, and then return on equity and return on assets. Asset utilization, we'll look at total asset turnover, days receivable, days inventory. Within pricing, we'll look at earnings per share and the price-earnings ratio. And in liquidity and solvency, we'll look at the current ratio and debt equity. You look like you want to say something.
I do. I mean, I know how much you love ratios. Mm-hmm. So what I want to ask you is, what's your favorite ratio category? And when you're looking at a company trying to evaluate them, do you weight one category more than the other categories, or one ratio more than the others, or how do you approach it?
If it's me, I go probably just the growth and profitability ratios. The increase, if I had to pick one of those, the increase in net income, is
bottom line.
That's probably going to be the most important one if I look at these. I've got a couple even, more favorite than this that we don't introduce in this course that might involve cash flows a little bit more, but
just wait for that PowerPoint series.
Who knows? But so increase in net income for me. How about you? Days inventory, is that the most meaningful?
Yeah, no, it's cool because it's a nice solid ratio, but I enjoy PE ratio because there isn't necessarily a right way to interpret that. It's kind of up for debate, up for argument. It's
true.
It's fun that way.
They don't even know what that is. We better get to it.
Stay tuned until we go through PE ratio.
We'll get there in just a little bit here. So, all right. Well, the increase in revenues ratio, what we're going to be looking at here is current year revenues minus prior year revenues, all that divided by prior year revenues. And the companies we're going to be using for these 13 ratios are Abercrombie & Fitch and American Eagle.
And why'd you choose those companies, Boz?
Because I figured that students might know of them, so I wanted to pick something retail. I also wanted to pick companies that were fairly similar in size and also that might have a little bit different of a pricing strategy, as we'll see in a little bit here. So, but similar retailers of potentially cool clothing, in the $3+ billion of revenues.
Potentially cool clothing.
Well, I don't know. I don't own any of this stuff.
Well, you got kids, don't you?
I do. I don't.
So shouldn't you know it's
cool?
cool?
I don't take them shopping. My wife takes them shopping, or I give them money.
So one more thing on all these following slides here. Each slide's going to go through one of those ratios we just discussed, and the amounts that you see. So for Abercrombie & Fitch, the net sales amounts, those come straight from their income statement, or in future slides it'll be on the balance sheet. But the titles that you see also are coming straight from the income statement. So if you were to look at their financials, you'd be able to trace these numbers right to them.
Yep, exactly. So, all right, the last 3 years here. Well, let's do the 2017 increase in revenues for A&F. And they went from... they're at $3.3 billion in 2017. They used to be at $3.5 billion in 2016. And we always divide by the baseline, which is the starting one. So you would not divide by 3.3 billion here. You divide by the starting point. And so in this situation, they've certainly gone down by a couple $100 million. So which is going to turn out to be a decrease in 5.5%. For their revenues.
No, that's not good.
No, it's not good. Now we can eyeball it and we can see revenues went up for this year by a little over 100 million, but what percent is that? They're up by about 5%. And with any of these, feel free to stop the video if you want to focus this a little more. We're not going to read every single number.
I was just going to say
like an 8-hour podcast, or I guess not a podcast, but a video.
I was just going to chime in and say that.
Were you?
Yeah.
So you want me to pause and edit this out so you can be the one to say that?
No, that's fine.
No, you can say it. So,
we're good.
All right, raise your hand in the future if you got something smart to say. So. All right, and then American Eagle.
This looks better.
Yep, we can see that from 16 to 17 they went up, and it looks like they went up by 2.5%. And then from 17 to 18 they went up by about 5.1%. Now it's important to assess a company's performance. So looking at this from A&F's standpoint, they certainly, well, first of all, higher is better, right? We want an increase in revenues. A&F is doing better than they did last year, but they're doing worse than American Eagle in both those years. Pretty close this year.
And it's nice to compare year over year. Maybe something weird happened in 2017 in the industry. Maybe some like Lululemon or something. Maybe they really blew up in 2017. So both these companies were down a little bit. But they recovered in 2018, and looks like American Eagle just did a little bit better in both years.
Exactly. So why don't you take us through the next one? There's 13, so we'll do every other one, but that means I get an extra, and I get 7 total, and you get 6.
I'm not taking this away from you.
Nope. I get 1 extra because I like them.
All right. So the next one that we're looking at here, increase in net income. Very similar formula, as you can see, to the change that we would have in revenue. Where we start with our current year net income, subtract that from prior year net income, and then we take that difference and divide it by our baseline, which is prior year net income. So what is our growth in net income from one year to the next? And as you can see with A&F here, it's going to be pretty bad for 2017 because 2016 they had 35.6 and 2017 they had 4.0. So we have a decrease there divided by 35.6. It's a negative 88.8%.
Yeah, there was something wonky that went on. I think they had a big one-time loss there. So
yeah, and companies will do that. It's the phrase "taking a bath," where if something goes bad, they'll just don't shortchange it. Just face up to it that they had a really bad time, and a bunch of expenses go through in that 1 year sometimes.
Yep, absolutely.
And so if we do the same analysis for 2018, you see we're going to have a little income growth there, net income growth of 77.5%, where when you get down to those lower net incomes, a smaller change in net income, which, I mean, this isn't bad. We're talking about $3.1 million here, so it's not a bad growth, but when your baseline is so small, you can have almost an outsized percentage there.
Yep, absolutely.
And so if we perform the same analysis for American Eagle, we can see they also went down in 2017 by 2.6%, so not as bad as Abercrombie & Fitch. But then in 2018, we have another decrease, which might be a little bit concerning, where you had a competitor, Abercrombie & Fitch, that recovered a little bit, increased, whereas American Eagle still decreased by 3.9%.
Yep, so we look at these and try to figure out who's doing better.
And as we're doing a change in net income, our analysis here, higher is better. So we want a higher number here. So Abercrombie takes the edge in 2018 with that 77.5% growth, but part of that is because 2017 was so bad.
That's exactly
and
right.
Knocked the income down that low.
Yep. So just a way we can zero in on that performance. Profit margin, the next one is just net income over net revenues. And for these two companies here, it's kind of like how much of their sales are they taking to the bottom line is the way we could look at
what's left over after everything else.
All the expenses. So they had about $3.3 billion of sales there in 2017. They're only left with $4 million. So 0.1% is what they took to the bottom line.
So if I spend $100 at Abercrombie & Fitch, what is that is going to end up as net income for them?
A dime.
That's crazy.
So, yeah. And again, I think it was a big one-time loss that year. And then in 2018, it's not much better. They get 20 cents to the bottom line. There was actually in 2018 the tax reform ended up having a big one-time impact on net income for them. But then American Eagle, go ahead. You want to say something?
That just seems a little. I thought tax reform was supposed to be a good thing for companies, Boz.
This is getting kind of advanced. It will be a good thing to help companies pay less tax and generate more profits going forward. But they ended up oftentimes having to make one-time adjustments in the year right before tax reform for a couple very complex reasons that are beyond the scope of this narrated PowerPoint.
Stay tuned for our next narrated PowerPoint series.
That's right. That's true. So deferred taxes and a one-time repatriation tax is what caused that. So American Eagle, this is a little bit more normal, but they took almost 6% to the bottom line in their situation. And then in 2018, not quite as profitable. They took 5.4% to the bottom line. I think this slide is really telling in that, both of these companies have fairly similar revenues. They're in the mid $3 billions. But one has got a couple $100 million of net income, the other barely has any. And that's certainly going to impact how valuable these companies are in the eyes of investors.
Something, you definitely want to look into as an investor to see why is that happening and does the share price reflect that or not before you decide to invest.
Exactly. So higher is better. Abercrombie is doing better, going from 0.1 to 0.2%, but bottom line, American Eagle is smoking them so far.
All right, so next one, gross profit margin. Gross profit, if you remember back to an income statement, is a little bit higher up than net income. So typically you'll take sales minus your cost of goods sold, and that gives you your gross profit. So what we're looking at here is essentially how much does it cost each of these companies to produce their goods, what's left over to cover all of their other expenses.
Yeah, so gross profit won't include things like CEO salaries, headquarter expenses, things like that. Just cost to make the products.
Yeah, exactly. So for 2017, we can see Abercrombie & Fitch had a 61% gross margin, and in 2018, it was 59.7%. So a reduction in gross margin is never going to make investors happy. You kind of wonder why, what's happening. Is that a long-term thing, or is that just a one-time issue in 2018 with input costs increasing? But it is helpful to compare it to a competitor like American Eagle here. And you see their gross margin was 37.9% in 2017, and in 2018 it was 36.1%. So they had a similar decrease as well. So maybe something larger happened in the industry. Our analysis again here, you want a higher gross profit margin, which Abercrombie & Fitch definitely has. So we would go with Abercrombie & Fitch in this case as far as being better.
Yeah, and it's interesting. So American Eagle, significantly lower gross margin. So that just means they're not marking up their goods as much. So if they're not marking up their goods as much, they're going to be cheaper in the eyes of consumers, and they're probably going to sell more of those goods is what's going to happen. So they're going to try to make their money having higher turnover, we will say, or more people buying stuff every day than A&F is going to. So we'll see that with a future ratio.
And actually, we kind of saw it there with net income as well, where they had a much higher change in net income.
Yep, absolutely. All right, and now we'll move on to return on equity. Basically, how much net income is the company generating relative to how much stockholders' equity that it has. Abercrombie & Fitch, as you would probably guess, they're not generating a lot of net income, only that $4 million. So they're only giving their stockholders a return of 0.3% in that 2017 year. In 2018, not much better because net income is still pretty low, and so only 0.6%. A little hint for trying to remember these formulas: whenever you are involving a ratio that has both income statement and balance sheet in it, you're going to average the balance sheet. If it's only income statement in the numerator and denominator, or only balance sheet in the numerator and denominator, you're not going to average. So it's when you've got both income statement and balance sheet that you're going to average.
Oh, that's good.
Yeah.
Thank you. That's a new one. Yeah.
It's a tip. So.
Yeah.
American Eagle, again, they had a healthier net income, so we're going to expect that they are providing more kind of return to their shareholders. 18.8% in 2017, 16.7% in 2018. So it went down partially because they made less income, but then also because they just had a higher shareholders' equity, so they weren't providing as strong of a return.
That's still a pretty good return, though. If you were one of those people who originally contributed equity, and that your numbers included in there, and you're earning 18.8 or 16.7% on that, that's pretty good.
Yep. No, it definitely is good. So the higher is better. Abercrombie's improving, but those numbers are just tiny. American Eagle is certainly throttling them in this category, even with their dip in 2018.
Who are you leaning towards so far?
Who am I leaning towards? So it's got to be American Eagle. They're making money.
They're making a lot more money.
Yeah, the bottom line. So that's what's happening. So, all right, I'll throw it back to you.
All right. Let's next talk about return on assets. Very similar to return on equity, except for in our denominator here, we are using average total assets as opposed to average equity on return on equity. I'm kind of glad accountants aren't that creative in their names for these ratios at this point.
Helps us remember it.
All right, so if we look at 2017, again, with that lower income for Abercrombie & Fitch, you're going to have a little bit lower return on assets, 0.2%. And then with a increase in net income, that's good, but we see their assets also increase a little bit in 2018. So we have a limited increase in return on assets of 0.3%. So we see some improvement there, which is nice, but
so tiny it almost doesn't matter.
Exactly, it's 0.1%. So let's look at American Eagle, who has a higher net income and, as you see, lower assets, meaning they are more efficient as far as generating income with the assets that they have, 12.5%, which is obviously much better than 0.2%. And then in 2018, where assets did increase a little bit and net income went down, so they're only at 11.3%, which isn't as good as 12.5%, but still much better than the competition. So if we finish up with this analysis tab here, return on assets, you want a higher return on assets. It's a great metric to see, are you able to efficiently use the assets that you have to generate a net income, bottom line, after all your expenses and everything. And American Eagle is doing a much better job of this than Abercrombie & Fitch.
Yeah, and this one tends to kind of trend similar to how return on equity trends. So, American Eagle, a little bit easier to see in that the return on equity for American Eagle was down in 2018 compared to 2017. But the more efficiently a company uses debt, the higher that its return on equity will be compared to its return on assets. In theory, if a company did not use liabilities or debt at all and got all of its financing from its owner, return on assets and return on equity would be the same. So that kind of the spread between return on assets and return on equity is how effective is the company in using its debt. All right, well, the next one, total asset turnover, and this is where I'm betting we're going to see American Eagle do better, just because if it has lower profit margins, lower gross margins than A&F, it's got to beat them somewhere, right? Abercrombie, we can look at this one, net revenues over average total assets. So they're sitting there at 1.4, all right, when we take their revenue divided by average total assets. And then the next year, their revenues are up by a little bit, and their average assets are actually fairly flat there. So they're 1.5%. So not a lot of movement. And I shouldn't say 1.5%. It's just 1.5 times is what that is. Now American Eagle. Let's see if my hypothesis is right. Yes, they have a 2.1 asset turnover in 2017. They have higher revenues but lower assets, similar to that point you made before about return on assets. And then in 2018, the revenues go up, but the assets are up a little bit as well, so it stays similar at 2.1. But this is how American Eagle is doing. This is a big area that they're doing better than Abercrombie. And higher is better. Abercrombie is slightly better, but American Eagle is doing considerably better. A company like Walmart or Costco, this is how they win, right? They just they do not have huge margins, but they have fantastic turnover.
High turnover, just getting people
Yep.
in, making a little bit off of everyone, and that adds up.
Sell a bunch of stuff.
Sell a bunch of stuff. All right. That works.
Yeah.
All right, so let's move on to days receivables. So with this ratio, we're going to first calculate our receivables turnover. And that's this part you see on the right here, net revenue divided by average accounts receivable. And what that tells us is, okay, here's the revenue we made during the year divided by what was our average accounts receivable balance, which gives us an indication of how many times did we collect those receivables in a given year. That's what we mean by receivables turnover. Now that number by itself isn't really particularly useful at all.
Yeah.
And so we're going to improve it by taking 365 divided by our receivable turnover to put it in days. And then to say, okay, it's taking us X number of days to collect. That's good. It's better than last year. It's worse than last year. It's better than our competitors, worse than our competitors. But then it's easier to analyze that way, just in your mind to think about efforts to improve collectibles. So if we look at this for Abercrombie & Fitch for 2017, we're going to start by taking $3,326, their 2017 net revenue, divided by receivables in 2017 plus receivables in 16 divided by 2. That's how we get our average receivables, just a simple beginning plus end divided by 2. So 365 divided by that turn is going to give us 8.2.
So on average, it takes them 8.2 days to collect their receivables. How'd they do in 2018?
That's not too bad, though, right? 8.2 days. Like,
yeah.
Deal with that.
And it's not super applicable to this industry because they sell more in cash. This would be a lot more applicable to an industry where they're selling more to other businesses.
Yeah. But they are still going to look at that just to see. And so if we look at 2018's number, they were at 9.0. So they got actually a little bit worse.
Yeah.
Right? It took them 8 days. Now it takes them 9 days. Are you concerned, Buzz? As a potential investor?
No, not for this company. This one isn't a big one. Let's still compare it to American Eagle just to see how they did.
No, I just want to quit.
You just want to quit?
No, I'm not going to do it. So again, American Eagle for 2017, we take 2017 revenue divided by 2017 ending AR plus beginning AR over 2 to figure out the average, and they get 8.5. And then if we look at 2018, they're at 7.9. Oh, hey, American Eagle looks like they're improving. Yeah, they're getting better.
Yeah, and let's just clarify on that one then. So lower is better. We want to collect our receivables more quickly. So Abercrombie, they got a little worse last year. American Eagle got a little better last year. So yeah, Abercrombie is a little bit worse, but these are still pretty close, and this probably isn't the most significant ratio to look at for these type of companies anyway.
Yeah, taking 1 extra day isn't necessarily
one extra day is good.
That big of a deal in the scheme of a multi-billion-dollar business. It takes them 1 more day to collect.
Yeah, but this is a big one for service businesses that provide a lot of services on account. As an example, this can make a huge difference for those type, or just
actually manufacturers too, where they're purchasing raw materials, so they got the accounts payable clock that's ticking for them. They're trying to generate the actual cash to pay back.
Like General Mills used to be a client of yours, right?
Yeah, absolutely. So they would watch this a ton, where they would say, how long is it taking us to collect? And so they would try and reduce that days receivables as much as possible, so they're collecting sooner, hopefully in time to generate enough cash to pay back their suppliers that they had to borrow from initially in order to purchase their materials.
Exactly. And certainly you could eliminate this altogether by not selling on account at all, but then, that would...
Then you lose some customers, potentially.
So it's a balance.
Yeah, a lot of big businesses have decided that it's worth it to sell on account to get those customers. So,
sure.
Similar.
Probably a bigger one is the days inventory side of things. So the concept here is the same. It's going to be 365 divided by turnover, but in this situation, it's inventory turnover, not receivables turnover. So we've got cost of goods sold in our numerator, average inventory in our denominator. That gives us our inventory turnover. How many times during the year do we sell our inventory? And again, 365 divided by that, how many days on average does it take us to sell our inventory?
Yeah, I like to think of this one, and it doesn't really fit, but just in my mind mentally, the turnover piece is like we're filling up our warehouse, right? We're getting it filled with goods, and then how long does it take us to empty it out and sell it? Okay. And that would be 1 turn, and how many turns we get, 365 divided by that would give us our days. So.
Sure, exactly. So in this one, we've got our cost of goods sold up top. We're going to divide it by our average inventories down below. So the 1.29 billion, and then the average inventory is 399 million and 436 million. And then when we do that, we see that it will take them 117 days to sell their inventory. That's kind of a lot,
Yeah, I mean, we're going to compare it right now, but just at first look, 117 days with, the way fashions change and clothing change, if you're Abercrombie and Fitch, trying to figure out, the right sizes and quantities to make, it's kind of a long term.
This would be bad if it was a grocery store.
That would be very bad. Moldy cheese.
Produce, that's right. But we could compare it. Did they do any better in 2018? We'll take 2018 sales over 2018 and 17 inventories, and they got 10 days better. I mean, I wouldn't doubt if that's something they looked at as a company and said, it's our days inventory is huge here. It's taken us a long time to sell. Let's try to make some efficiencies. I wouldn't doubt it. In 2017, American Eagle, same concept, COGS over average inventory, only was taking them 54 days to sell.
That's a significant advantage.
It is.
17.
Yeah, and I'm sure Abercrombie looked at that, and they said, okay, why is their days inventory so much lower? Is there something we can do differently.
And think about all the costs too associated with storing that inventory for Abercrombie and the warehouse security. And
you mentioned styles; it can go out of style. It can
There's
get
a lot
stolen,
of risk associated with that.
It can go out. You can go obsolete. You can have a fire. Anything like that. And then American Eagle in 2018. Who knows? Maybe they looked at Abercrombie and said, "Wow, we're way better than them. We can relax a little bit." And they did get a little bit worse in that regard, but they're still, they're crushing Abercrombie because here lower is better once again. So Abercrombie, they're performing better than last year, but much, much worse than American Eagle in both years.
So in this case, I'd be more excited about American Eagle.
Exactly.
All right, so the next one, earnings per share. This is probably the single most watched ratio by analysts, I guess, anywhere, I would
agree
say.
with that.
You take the net income, but instead of just having the raw dollars for net income, you divide it by the average number of common shares outstanding. So that gives you a sense of, if I buy one share of stock, what piece of that net income would be allocated to me. It doesn't mean you're going to get that, but it is a nice way to compare companies of vastly different sizes, just by looking at how much income do I get for every share that I own. And so if we look at this for Abercrombie and Fitch, you can see in 2017, hopefully that net income number is getting pretty familiar to you, 4.0 divided by around 67.5 shares outstanding, gives us earnings per share of 0.06. This is not very good. It's pretty low. In 2018, we can see do they have any sort of improvement, and they're only at 10 cents per share, which again is still pretty low. So having that really low net income really drives down earnings per share, and they're probably going to take a pretty big hit as far as their market price goes as a result of that. American Eagle, if we look at them, a lot higher net income to 12.4 over 181 shares outstanding, gives us $1.17, which again, this varies a ton across industries, but that's pretty good, at least relative to Abercrombie and Fitch. And then you can see here in 2018 they're at $1.14, so we do see a decrease. Probably not excited about that. Analysts probably don't like that. Share price goes down, but still better than Abercrombie and Fitch.
Yeah, and usually if net income goes down, earnings per share will go down. Not always, because sometimes if a company buys back some of its shares, the shares would go down by more proportionately than the net income.
Yeah, and so Abercrombie going up, we're happy about that. American Eagle going down, we're not happy about that. But Boz, you don't like to compare across companies with EPS. Why not?
A company can choose how many shares it wants to have outstanding. So, and some companies will just decide to have a lower or higher number of shares outstanding to kind of manage its share price a little bit more. Berkshire Hathaway, their share price is probably a couple $100,000 right now. So wherever their earnings per share is at, I don't know that off the top of my head, but if they did a stock split and just a 2-for-1 stock split and suddenly had twice as many shares, that would impact their earnings per share, but really not, have any measurable impact on the shareholders of the company. So it's based on how many shares you choose your company to have.
And when I was out at General Mills, we were talking about them earlier. They had an active strategy where net income was roughly flat over a number of years. So to increase earnings per share, they were repurchasing a lot of shares into their treasury, which reduces the number of shares outstanding. So driving EPS growth that way.
Yeah, you could set up a company and make $5 Trinka Honey or something like that, right? And just choose that your company has one share, and so then you'd have $5 earnings per share.
I thought you said we made $1.
just play with me here yourself. But
okay.
So Trinka Honey has one share, makes $5, $5 earnings per share. Does that mean that you are better than Abercrombie or American Eagle?
I have a higher earnings per
share, right? So it just wouldn't be applicable if you had 70 million shares outstanding or 180 million shares outstanding like those two companies. Your earnings per share wouldn't be so high. Anyway, where we can use this in order to compare across companies a little bit more is the price earnings ratio. So what is the market price per share, the stock price per share, divided by earnings per share? So for Abercrombie, we looked up the market price per share, and it was $21.12. And again, on the previous slide, they made a dime per share. So in that situation, they have what's called a PE ratio of 211. So as Abercrombie just continues to make a dime each year, it'll basically take them 211 years in order to repay their shareholders.
That seems like a long time.
It does. So we'll get to that in a moment. Why that is. Then American Eagle. This is a little bit more classic. So $24.83 per share. They made $1.14 per share, and they have a PE ratio of 21.8. Now, if we look at this one, the analysis, the higher, it's not that higher is better or worse. It just implies generally that investors believe that the company has higher growth prospects, particularly with Abercrombie. They had a couple one-time items impact their net income. So investors are really counting that those one-time items are not going to repeat themselves. So they have a lot higher growth prospects.
Basically, Abercrombie and Fitch, they've inspired enough confidence in investors over the years that with a couple of off years with some big expense items, their stock price necessarily isn't just going to tank where everyone loses faith that they're going to stay up there and not be able to generate income anymore.
Yep. So this ratio here, you really like this ratio. This is kind of the great equalizer, right? A lot of the other ratios drive this one.
So what I love about this one is that you can make an argument with Abercrombie and Fitch, say, yeah, it's 211.2, it's really expensive, but it's expensive because it's such a high quality income, right? I have enough faith that they're going to generate income that I'm willing to pay a high price right now, knowing that income is low, but I have enough faith that it's going to go up down the road. So I could make you a very convincing argument why Abercrombie and Fitch is better, right? Higher quality. On the other hand, I could also make a very convincing argument that American Eagle has a better PE ratio because it's such a better deal. It's so much cheaper. It's only going to take me 21.8 years to earn my investment back versus
assuming no growth, which isn't the case.
Versus 211.2. Like 21.8 is such a better deal. I don't know how much faith you have in Abercrombie and Fitch, but being able to earn that back in 21.8 relative to 211.2 just seems like a much better deal, a much safer bet for me.
And we'll pull this one back on the summary slide as well. We go on to the next slide is this one's yours, isn't it?
I think so. I kind of lost track a little bit. Current ratio, this is, a pretty quick hitter, I guess. A lot of companies look at current assets over current liabilities to get a sense of, do they have enough available in current assets, things they're going to turn into cash in a year, to pay all their current liabilities. And as we can see here, with Abercrombie and Fitch, they're at 2.3 in 2017 and 2.5 in 2018. So what this means is that 1.0 would be, break even just enough. They're more than double that, so they're fairly safe, I guess. I would use words like aggressive versus conservative here. Some highly established companies that are really, really good at cash management and investing excess cash into the business, longer term assets, they'll have current ratios even below 1.
Like Walmart has 0.8, I believe, is where they where they've historically sat, and that means they have more current liabilities. So stuff they got to pay off in the next year versus current assets, stuff they expect to be cash in the next year. That does not mean Walmart's going bankrupt.
No, it does not. They're just very aggressive, and they can generate the sales or generate the cash through their sales to pay off the liabilities as they come due. Yep. Whereas Abercrombie and Fitch is a little bit more conservative. If sales do fall through for whatever reason, they have enough in current assets to cover their current liabilities.
I look at that. They're not going bankrupt in the next year is one quick conclusion that way. But if a company had a current ratio that was like 0.1 or 0.2 and they're not profitable or whatever, I would be really concerned that they'd be teetering on the verge of bankruptcy.
Yeah. So let's move on to American Eagle. In 2017, they were at 1.8. And in 2018, they're at 2.0, so a little bit more aggressive here. I'm not going to argue that one is better than the other. You could say American Eagle, it's more risky, but maybe you're looking for a little bit more risk. That could mean they're more heavily invested, I guess, in their business to focus on growth, whereas Abercrombie and Fitch is more focused on just, I guess, remaining consistent. I don't know a better way to say that, probably. Sure. So Abercrombie slightly more conservative than last year, and more conservative than American Eagle.
And I think this is one of the most common ratios where people, in my mind, would get it wrong. I think a lot of people would say Abercrombie is better here. That's not the case because American Eagle's not going bankrupt anytime soon. the extra current assets that Abercrombie has, it's not like they're free. They had to pay for those assets somehow, so they've got extra assets on their balance sheet that they're tying up that way. So in theory, a company wants to keep this ratio as low as possible without having a risk of bankruptcy. I think that brings us to the final ratio. So the debt equity ratio.
There's a lot of these things.
There really are. So
and there's even more we're not going through. We're just picking some of the big ones, the basic ones, get our feet wet a little bit, and then roll in your other classes with some more intense ones.
Absolutely. So the debt equity ratio, this one can be computed a lot of different ways, and you will see this one differently in a finance class. So just be aware this is like an introductory way to compute it for a first accounting class. Total liabilities divided by total stockholders' equity. And in this situation, they have liabilities of $1 billion, stockholders' equity of about $1.25 billion. So they have 0.83. So we can say for every dollar of equity they have 83 cents of liabilities. And that was in 2017. In 2018, it follows a similar trend. They have a little bit more liabilities compared to equity, 0.86. American Eagle.
That seems like a lot to me.
A lot of liabilities.
A lot of debt, yeah.
A lot of debt. So, companies grow with debt. Basically, is one of the ways they grow. A lot of that could be, very low interest debt or non-interest bearing debt at all, like accounts payable.
Yeah, debt has been cheap in recent years, so a lot of companies have taken on a bunch of debt just because it is cheaper than equity, they say.
Yeah.
And we're probably getting ahead of ourselves a little bit with this class, but
Sure.
It seems high, and companies don't necessarily view debt as a terrible thing.
Yeah, just like you. I mean, we're sitting in your house in Sartell right now. Did you pay cash for this thing?
Straight cash,
Straight cash, homie. And is lying.
I did not, but I just want to say straight cash, homie.
That's right. So, but yeah, you've got debt, right? It's a way that you're able to afford getting into this house or to acquire this asset, just like these companies do as well. American Eagle, they have, as you can just kind of eyeball it, they have less debt as compared to their stockholders' equity. So their ratio is actually 0.48 in 2017, and it's 0.46 in 2018. If we do a comparison, the more debt you have, the more aggressive you are. In general, interest is pretty cheap. So higher debt gives you an opportunity to get higher returns by borrowing at a low rate and then investing at a higher rate. But the more debt you have, the more risk you have of going bankrupt. No one has ever gone bankrupt without any debt. Did you know that, Ben?
I never thought about it, but you're right. And riskier for shareholders as well, because in the event of a bankruptcy, whoever issued the debt to whatever company, Abercrombie and Fitch, they get their money back first, and shareholders are kind of at the bottom of the totem pole getting whatever's left over. So makes it riskier for shareholders, but potentially greater returns too.
Yep, absolutely. So Abercrombie definitely more risky in this one. Well, if we summarize this all, and I'm going to take the summary too, I was
going to ask you to walk us through this thing. We got a lot. We've talked through a lot so far in this PowerPoint. So
if we look at these, as far as how they're doing, we're just showing the 2018 comparisons here. The biggest ones that are jumping out is the ones that we say much better. So like the growth, increase in net income. Well, A&F was much better, but that was because it was tiny.
Small number.
Yep. That was one of the reasons. So we kind of discount that because it was tiny. And now we go down to the profitability, profit margin, return on equity, return on assets. American Eagle was much better.
Actually, for a second, who do you give the edge then in growth?
Of those two companies. Growth.
Yep.
So I would actually give
kind of like segment by segment almost.
Yeah. I would in this situation. I would give it to the consistent company. And American Eagle is the one that's been more consistent.
5% growth in revenue.
Yep. So I would have just given it to them, I guess. So but
I would agree with you there.
Yeah. Even though that high number, that 77%, is just an outlier. So. But so the biggest thing's profitability. American Eagle is doing much better here. Asset utilization, we can just see in that situation, the American Eagle is also doing better. Just partly they're having higher turnover. They're keeping their receivables and inventory lower. Now the pricing, we see the big difference right there. That Abercrombie is a much higher PE ratio. And then on the liquidity side of things, that one of them is more conservative, Abercrombie with the current ratio, American Eagle with the debt equity ratio. So we just look at this, and now we can make an investing decision. I mean, if these companies had the same amount of shares outstanding and the stock price was the same, I mean, which one would you invest in at this point in time here?
Oh, American Eagle for sure. If the same shares outstanding, then I see that change in income like we talked about. Not change in income, just the raw dollar amount of net income. I get much more net income for every dollar I invest with American Eagle. But
that profit margin is
they're not the same is the thing.
Yeah, no, they aren't. So they have a lot higher profit margins. So that would drive it. But you know what? It's not just us sitting here who think that. That's other investors, and that's why their PE ratio was a lot lower. It's cheaper. So if you if you wanted to invest in someone like that, Abercrombie, due to that lower net income, does have a much higher PE ratio. So question for you. So these companies each.
You were waiting for this the whole time, weren't you?
I was. So these companies are similar in revenues. They're each about $3.5 billion. If I made you kind of compare market capitalizations of these two companies, which is share price times share outstanding, would you have any guesses on that one? Again, they're each about $3.5 billion of revenue.
Yeah, so same size with revenue, but I see that American Eagle has much greater margins, much more profitable with that same size of revenue. So I think they would have a higher market cap because investors would value American Eagle more highly. Basically, they can do more with the revenue that they have.
Yep.
But am I right or am I wrong?
You are right, and it's about 3 times different. So it's Abercrombie is valued at about, I think it's $1.5 billion, and American Eagle is closer to $4.5 billion. So those are just rough estimates there, but just due to they're showing that they can sustain profits.
So maybe now's a good time to buy Abercrombie & Fitch then.
It's an interesting one, right? Yeah, it does. If you think they're going to come back, it definitely would be a more attractive one to buy.
It's more risky, I would say,
but absolutely.
There's a lot of potential for higher returns. So maybe, if you're a younger investor and you have some time to ride the highs and the lows, you don't think they're going to go bankrupt, go for it.
Yep.
But if you're closer to retirement,
like me, pats me on the back.
Maybe you should go American Eagle instead.
That's right. So this has not Ben giving you investment advice. So if you invest in Abercrombie and lose, don't call me for sure.
But if you invest and win, go ahead and give us a call.
Give us a call. So heads we win, tails you lose.
Yeah, I think that's pretty much what it is.
Yeah, but we're just touching on it. You'd have to go through an investments class or something to get a better feel for that.
And actually, one thing we haven't talked about is that these ratios are just one piece. Before you make an investing decision, you're also going to want to look at a lot outside of just the financial ratio. So in accounting course, ratios make a lot of sense, but you also want to look at market position. What are their plans for growth? Where are they? Things like that.
So basic introduction to financial statement analysis here.
Yep.
So to wrap it up, the key takeaways, creditors, investors, and managers, they're going to be looking at these percentages and ratios in order to make some meaningful comparisons and decisions. When you're performing percentage analysis, if you remember that from the start, we want
seems like a long time ago.
It is. Look at each account or subtotal as a percentage of that your sales. And then when you're use ratios in order to compare the company's performance against itself and its competitors, but then understand how to interpret those. They're not always better or worse. They could also be more aggressive or more conservative.
Yeah, and on that point, really focus on the interpretation of the ratios because you can get a computer or some software, some website. You
can find them in Yahoo Finance.
Yeah, they're going to be out there, right? So, you need to know how to compute them so you understand what's going into it. But the interpretation, that's the key. Why is something better or worse or more aggressive, more conservative? Knowing that is a key takeaway.
Yep, absolutely. Well, that wraps up our narrated PowerPoint series. This was our longest video. We had to pull it all together. There was, probably the most computations and everything to pull into this one. So
thank you for tuning in, not just for this one, but for the entire series. We hope you had as much fun as we did going through these. And who knows what's coming in the future?
Who knows? So great job, buddy. So,
you too.
Yep. We'll see everyone around.
Boz Bostrom, MVP.
I'll give it to you. So, but all right. Take care, everybody.
Bye.